Imagine you put your entire savings into a stock. You watched it climb for months. You felt like a genius. Then one morning, you wake up, check your phone, and it is down 40%. And here's the terrifying part. You do not sell. You hold. You tell yourself it will come back. Was that logic, or was something else controlling your decision? Because here is what nobody tells beginners about investing. Your biggest enemy in the market is not inflation, not interest rates, not even bad stock picks. It is your own brain. And by the end of this video, you will know exactly how your mind is quietly sabotaging your money and what to do about it. Your brain was not built for investing. It was built for survival. Thousands of years ago, if something scared your ancestors, they ran. Fast decisions meant staying alive. But in the stock market, fast emotional decisions almost always mean losing money. The same mental shortcuts that kept humans alive on the savannah are now quietly wrecking portfolios in 2024. Psychologists and behavioral economists have spent decades studying this, and what they found is shocking. Most investors, even experienced ones, fall into the same mental traps over and over again. These traps have names. They are called cognitive biases, and you are probably experiencing several of them right now without even knowing it. Let us start with the most dangerous one. It is called overconfidence bias. Studies show that the majority of investors believe they are above average at picking stocks. Think about that for a second. The majority cannot all be above average. That is mathematically impossible. When you have a few winning trades, your brain floods with dopamine, the same chemical released when you win at a slot machine. You start to believe you have found the secret. You start trading more, taking bigger risks. And that is exactly when the market humbles you. Overconfidence does not just make you wrong, it makes you confidently, expensively wrong. This bias alone has wiped out more beginner investors than any market crash in history. Now picture this. The market drops 10% in a week. Every headline screams disaster. Your friends are panicking. So you sell everything. 2 months later, the market has fully recovered and then some. But you are still sitting in cash, too scared to get back in. What just happened to you is called loss aversion. Research by psychologists Daniel Kahneman and Amos Tversky proved something fascinating. Losses feel psychologically about twice as powerful as equivalent gains. So losing $1,000 feels twice as bad as gaining $1,000 feels good. That imbalance drives panic selling. It makes you make decisions based on pain avoidance instead of rational thinking. And it costs the average investor years of compounding returns. Here is one that is a little sneaky. Have you ever bought a stock and then suddenly started noticing only the good news about it? You scroll past the warnings. You dismiss the analysts who say sell. You find the one optimistic article and share it in the group chat. That is confirmation bias. Once we make a decision, our brain desperately wants to be right. So it filters information, it highlights what confirms our belief, and it buries what challenges it. This is why people hold losing stocks way too long, not because of logic, because admitting the stock is bad means admitting they were wrong. And the human ego, it really does not like being wrong. Awareness is your first line of defense against this one. Let us talk about something you have definitely seen on social media. A stock starts going viral. Everyone is talking about it. Influencers are posting gains. Reddit threads are exploding, so you jump in. This is called herd mentality. When humans are uncertain, we look to others for cues. It feels safe to follow the crowd. But in investing, by the time everyone is talking about something, the smart money has usually already been made. You are often buying the top. Remember GameStop in 2021? Millions of people followed the herd in. Many of them bought at the peak and lost significant money when reality caught up. The crowd feels safe. But the crowd is usually late, and in markets, late is expensive. This next one is subtle but brutally costly. You buy a stock at $100. It drops to $60. A financial advisor tells you it is fundamentally broken, sell it and move on. But you refuse. You say you will wait until it gets back to 100 before you sell. That is anchoring bias. Your brain has locked onto the original price as a reference point. It is treating that number like it is sacred, but the market does not know what you paid. The market does not care. That $100 anchor is not a real thing. It is a number in your head. And holding a dying stock while waiting for it to return to your anchor price has destroyed more wealth than people realize. The stock has no memory of what you paid for it. Now here is something counterintuitive. The investors who check their portfolios the least often tend to perform better than those who check daily. Why? Because of a bias called present bias. Our brains naturally overweight what is happening right now and underweight what happens in the future. When you check your portfolio every day, every small dip feels catastrophic. Every small gain feels like it needs to be locked in. You start making short-term emotional decisions in a game that rewards long-term patience. Studies have shown that investors who trade the most earn the least. The urge to do something, anything, when the market moves is one of the most expensive feelings you will ever act on. Sometimes the best investment decision is to simply do nothing. So how do you actually fight back against your own brain? First, write things down. Before you buy anything, write out exactly why you are buying it. What is your thesis? What would make you sell? This forces your logical brain to do the work, not your emotional one. Second, build rules and follow them. Decide in advance at what point you will cut a loss. This removes panic decisions because the decision is already made. Third, slow down. When you feel an urgent need to buy or sell, wait 24 hours. That urgency is almost always emotion, not intelligence. Your brain is fast, markets are long. The investors who win are not the smartest people. They are the most disciplined, the ones who learn to pause when their instincts scream to act. Here is the real truth about investing that most people never hear. You do not need a perfect strategy. You do not need to predict the market. You need to understand yourself, your biases, your emotional triggers, your ego, your fear. Because the investor who knows their own psychology has a massive edge over the one who only knows charts and numbers. Every bias we talked about today, overconfidence, loss aversion, confirmation bias, herd mentality, anchoring, present bias, these are not signs of weakness.